Hello, and welcome to this education edition of Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook. And over the holidays, we decided to do a couple of very basic option, basic option guide TVs that cover, first of all, what is an option contract. And we did that already in Options 101, got into the details behind what makes up an option contract. And today in 102, we're going to talk about the basic option strategies. And we'll even bring up the TradeHawk software inside the Tradier platform. And we'll look at what it takes to actually enter an options order. So this will be a very basic event, but I want to give you a couple of hints into some of the mistakes that I see beginning option traders do. So let's use the Options Playbook website, which is the book that I wrote, optionsplaybook.com, and we'll start with the most basic trade that is out there, just a long call spread. So let's jump to the Options Playbook right now, and a long call, not long call spread. Okay, so first of all, if you're talking about options and the vernacular down on the trading floor, long means that you have bought that option contract. Short means that you have sold that option contract. So I enter an order to buy my call option, and then once I have bought it, it becomes long in my account. And in the short side of things, the concept is that I enter an order to sell an options contract. And once that order is executed and goes into my portfolio, I am then considered short that option contract in my account. So inside the playbook, we use the term long to highlight that we bought this call option. Now, we're looking at a profit and loss graph, and we're looking at that at expiration. So if I buy an option contract, I have limited and known downside. So I find an underlying stock that I like. I buy this option contract. If the market goes up, well, in that instance, on our profit and loss graph, on the x-axis, this is where the strike price is strike A. If the market continues on up, you have unlimited upside potential all the way up to infinity. Stocks don't usually go there that often. But ideally, if the market goes up, my long call option will go up in value. From strike A, this is the strike price. Whatever I paid for that option contract, if the market goes down, that is going to be my max risk. So each option contract usually represents 100 shares of stock. If I am buying an option contract, and it's my first time buying options, and I do find an underlying stock that I want to trade, one of the things that we want to be mindful of is that there is a lot of leverage. Options trade for a lot less than the underlying stock. So if I normally would buy 100 shares of that underlying stock, one call option will represent 100 shares of that stock, and that's where I would start. You don't buy as many call options as you possibly can, only because they trade for a lot less than the stock, because if you do that and the market just goes down, you have limited and known loss. But if you used all of your money that you were going to use on the underlying stock, well, you have a much higher potential of losing all of that investment in that option contract, because if the market is below strike A, the actual strike price on that expiration date, you could lose that entire investment. So, moral to the story, watch the leverage. If I normally buy 100 shares of stock, realize that an option contract usually represents 100 shares of stock. And if I'm first trading options, I really just want to buy one option contract overall. Now, the other strategy that is one of the beautiful things about option trading is that if you have a forecast, we can adjust our strategy to meet that forecast. So if you want to be bearish on an underlying stock, In the real marketplace, that stock, the only way to get bearish is, I should say, in the stock marketplace, not the real marketplace, but in the stock market, is you actually have to sell a stock short. That means that you're selling a stock without owning it, and you're borrowing it from the brokerage firm to sell those shares. And if the market goes down, you hope to buy it later at a lower price, hence sell high, buy later low, doing everything backwards. And in that instance, you would be profitable, but there's a lot of headaches with it. You cannot do it in a retirement account. You have to have a margin account in order to do it. You have to have the shares available. The brokerage firm is loaning you those shares. And there are other fees that go along with it. So in the options world, you don't have to deal with a lot of that. You can just buy a long put. And if you buy a long put, once again, that's strike A. If the market goes down, as long as it's prior to the expiration date, you can be profitable on that trade from the underlying market going down. If at expiration, it finishes above strike A, that means the underlying stock went up, you can lose your entire investment. And it's the same concept here. You got to watch the leverage factor if you are buying options. Realize it represents 100 shares of stock. If you were thinking of shorting 100 shares and you're a beginning option trader, you're going to want to just buy one option contract and get a feel for the marketplace. You don't want to use the leverage factor and get yourself in trouble. And that's one of the biggest things about beginning option traders. They have a tendency to like to start by buying long calls and buying long puts, and then they use too much leverage to start with, not realizing how leveraged this security is if you're going to be trading it. So I'm going to go to the actual Tradier software, and I am going to place a long call and a long put. Well, we'll look at what it takes to put one in. We won't send it to the trading floor. And talk a little bit about the different types of option contracts. And then I'll give you a strategy where I think you should start if you want to get your feet wet trading options. All right. So I'm going to tab over to our test account in the TradeHawk software. And I'm going to clear this out. Let's do something like Apple. Most people know what Apple is, right? And if I'm looking at Apple, and we're going to go out, we'll go to January. We have many different expirations to choose from, and we covered that in the 101. But if I look at all these different expirations, I want to be pretty certain that if I buy this January 5th expiration, that there's a reason why I think Apple could go up in price if I'm buying calls, or go down in price if I'm buying puts. So in this instance, we're going to do the most simple trade. We're just going to go out and look at buying a call option. So underlying stock is at 194.80. Inside the options grid, or the option chains inside the TradeHawk software, we highlight for you where the underlying stock is at, the most at the money option contract. And the underlying stock is 194.74. So the most at the money option contract is the 195 strike call. This would give me the right to control 100 shares at the price of 195, which is that strike price. So here's part of the leverage. If I'm going to buy that, I'm going to be looking at the price of the option contract is the price times 100 shares. So in that instance, if you are buying, if you see this is kind of nice, it's right at $3. If you're buying if you're paying the ask price for the 195 strike, and these are call options on this side, these are put options on this side. If I'm buying that, I am paying $305 plus commission to own that underlying stock. Now, if I want to go out and buy 100 shares, I'm talking about 195 or 190, and we'll round it up a little bit, 195 times 100, or $19,500. So 300 divided by $19,500 is you're looking at 1.5% of the stock price. So that's what I mean when we're talking about leverage. Very 1.5% of the total cost to buy 100 shares of underlying stock. I can buy a lot of them. But I also got to realize that if the market finishes below 195, I can lose everything that I bought. So if I'm looking to buy one option contract, quite simply inside the TradeHawk options grid, all we do is look at the ask price, click on that, and that will put it down here in what we call the order ticket. And then we make sure that this is the option that we want to buy. We're going to buy one. Here's the expiration date. As I mentioned, January 5th expiration, 18 days remaining. And I can double check by looking over here, January 5th, 2024. Buying that one option contract. The current price is $3.10 if we bought it. That would be $310 if we paid where the current market was at. If you were selling the option contract, that would be the bid price, which is $305. And the midpoint of both of those option contracts is $308. So we're going to send this at a limit price of $3.10. And that I'm always going to put a limit on my option trade just because the markets are a little bit wider, not quite as liquid as the underlying stock. So I'm almost always going to enter something at a limit price instead of just sending it at the market. And you should still fill instantly. You just don't want it to tick up a nickel and you get filled 5 cents higher and you paid an extra $5 for that trade. So limit order means that we're going to send it at that limit price. And if the price is there, they will execute it. A market order means we're willing to pay whatever the price is on the marketplace. And that's how I would buy one long call option in an underlying stock like Apple. Now, on the put side, it would be the same scenario. If I wanted to buy the 195 strike put, I look over here, I see the ask price, and I can remove this. Now we're on the other side of the chain, and I click ask, and that would show me that I'm buying this one put option. Same concept, except I want the underlying stock to go down. And we'd look at that expiration, 195 strike put, and that's $2.59. Now, the put is a little bit out of the money relative to the call option, so it trades for a little bit less. Hit send and put it in as a limit order right at that ask price of $2.59, and it will cost you $259 plus commission to put on that trade. Okay. So if I'm buying options, a lot of people would say, well, why am I paying $3 for it when I can buy this option contract and pay 65 cents for it? Why not buy the cheaper option contract? Well, you can buy more of them, and you do sound really good at a cocktail party. Yeah, I just bought 20 option call or Apple call options today. So you can buy a lot more with the same amount of funds. But now, if you do that in the options trading world, you're really saying that you expect that underlying to get to that strike. If it doesn't get to the strike by that expiration date, excuse me, what ends up happening here is that your option will expire worthless. And even though you own more of them, you still got to say, do I think that underlying stock will get to that price? So we're talking here 7.5 points. 7.5 points on a $195 stock. That's 4% in 18 days. That's a decent return over months, let alone in 18 days. So you got to look at what you're asking the stock to do if you're buying out of the money option contracts. And also on the put side. So they are cheaper, but they're cheaper for a reason. You get what you pay for. You need the underlying stock if I buy this call option as opposed to buying the at the money or even in the money option contracts. If I'm buying this option contract, I really need to be confident the underlying stock over the next 18 days will at least get to this strike and go beyond. because if it doesn't, I can lose my entire investment. Okay, so how might I trade better? Well, I'm going to jump back out here just for a second. Let me jump back out. And I'm going to suggest in the options trading world, and now we're back in the options playbook. I'm going to go to the rookies corner inside the options playbook, getting your feet wet. This section is literally called getting your feet wet, and you can read a little bit more about it. But as opposed to just buying an option contract or buying an out of the money option contract, I suggest that we actually sell a contract, that you sell a covered call on a position that you own. Let's say we're getting to year end. You might want to sell a stock just to try to clean up your portfolio or whatever. Why not, instead of buying that option contract in Apple, maybe you want to sell 100 shares of stock. How about you sell that option contract for 65 cents at that strike price? And if it gets up to that strike price, well, then it will get called away. And all you'll be doing is selling your stock higher. Doesn't have to be Apple. It could be whichever one you want. But by starting with covered calls on a stock that you don't mind selling, inside your portfolio, you learn a lot about the dynamics of the option pricing. So this goes through an entire scenario of what would happen inside the options playbook on writing covered calls. And we'll run back and go to the option strategy that I actually have it highlighted in the rookie section. And I guess you could put covered call. All right. And you'll see that all a covered call is saying is, I own 100 shares of stock. If the market goes up to that strike price, let's say it made, in our instance, on that out of the money call option, it made a 3.8% move over the next 18 days. All right, go ahead and call my stock away from me. And this is what the profit and loss graph looks like. It looks like if you own underlying stock, you still have risk to the downside, and you have substantial risk or substantial upside all the way up to the strike price. But then at strike price, you're going to just be selling the stock higher. Not much different than a limit order saying that you can sell my stock at that price, but I get cash now for saying you can take that stock away later. And that's the covered call strategy. So if you'd like to learn more or get your feet wet trading options, check out the options playbook and think about a covered call strategy as opposed to just buying an option outright. That's where I think a lot of beginning option traders should start. And that's it for this episode of Options Guy TV. We are every Monday, Wednesday, and Friday at 11 a.m. Eastern time. Please click subscribe and ring the bell, and we'll see you at the next edition of Options Guy TV. Thanks for coming, everyone.